Today, we're talking about using your home to wipe out debt, and we're going to spend the first half of this telling you why you probably shouldn't do this. Your home's equity is sacred. There's a reason for that, and most people have never had it explained to them.
Yeah, the pitch everybody gets in the mail is consolidate your debt, lower your payment, or what are we saying, Bill? Pump the brakes on that?
Yeah, bump the brakes. There's a version of this that's smart, and there's a version of this that probably puts your house on the line. We want you to know the difference before anybody sells you anything, right?
Yeah, so that's what we're going to talk about first, and then we're going to do a quick market update.
Yeah, so welcome back to the South Florida Mortgage Report. It's Billy Mei, your hat dude and wear mortgage guy. I got a new hat this week. And always joined with Craig Garcia, president of Capital Partners Mortgage, and quoted nationally in CBS News, I shall say, actually. So
Recently, that was the case. We put it on the website, and so that was a good one. Yeah.
yeah, very, very cool. So let's start with the why not? Why shouldn't somebody do this, Craig? Why shouldn't a debt consolidation take out a second mortgage? Why wouldn't they?
Well, so let's say you got credit cards, a personal loan, unsecured debt. If you have a problem, you can't pay your unsecured debt, a creditor can sue you, they can get a judgment, they can garnish your wages. But what they can't do in Florida is they cannot come after and take your primary house because you have homestead protection.
Yeah, a lot of people are not aware of that.
Yeah, I don't. And so the part that matters is that the second that you roll unsecured debt onto your house, you've handed your creditors the one thing that they couldn't touch you with before, which is you took protected debt, so to speak, and you secured it with your home. And so now it's a little bit of a different situation.
Yeah, so consolidation literally strips the protection.
Yeah. And I think people that are looking to do this would need to be honest about the pattern of behavior that they've been doing. If somebody's been running up balances on their unsecured debt and what they really want is a lower payment, you're not really getting rid of the debt. I mean, that's a habit that you don't want to involve your home with, really. Lowering the payment might feel like progress, but it may actually not be.
Yeah. I mean, because the danger is there is that your credit cards, people can just go out right back out and charge them up.
It definitely can happen. And so if you do that, then you lower the payment, secure it against your house. Now you still got the cards. You still got the cards again. And if you're going to run those back up again, now you have those again, and you have a bigger mortgage, and you're turning a 3 to 5 year problem into a 30-year problem or 20-year problem maybe. So even at a lower rate, stretch it out long enough, you're going to pay total interest. Lower rate is not the same thing as less cost if now you're just stringing it out for a super long time.
Yeah, so before anyone touches the house, right?
Try to kill the debt without your house first. And we built a free tool on the website for people to play around with this. It's on our site. We'll put the link in the show notes. It's a debt payoff planner. All you do, we're not collecting your information. You just go in there and you input, hey, I've got a credit card. This is the balance. This is the interest rate. This is the minimum payment. And you put all your different debts in there, and then it's going to tell you how long it's going to take you to pay off at the current payments, what order you should pay the stuff off in if you want to pay it off faster. If you say, hey, I'm going to throw an extra, $300, $400 a month towards this debt, it'll tell you, okay, here's your two different options to pay this debt off faster. One being what's known as the avalanche method, which says, hey, go after the highest debt first and pay that off, put all the extra money towards that debt first, extinguish that, then go on to the next highest interest rate. So that's the avalanche method. So it's got a calculation for that. It'll show you how long it will take to pay off if you go that method. And then there's another method, which is a psychological thing. It's actually not saving you more interest over time, but they call it the snowball method, which says, go after the smallest debt first, because psychologically, if you get rid of one thing quickly, it's a good positive reinforcement, and you can chalk up a win, and it keeps more people on track, or keeps some people on track. So it gives you both. You can look at it both ways, and and decide for yourself and play around with it. It's just another tool that we're putting out there on the website. So
Yeah, it's free. It's on the site. It's called the Debt Payoff Planner.
Yeah,
It's great, and I like both options. And I've worked with people who's saving to buy a home, or they're trying to do some, and they ask me their opinion on numbers, and that the snowball one too is good too, because there's a personal confidence when somebody, hey, I knocked out this card, I knocked out this card, knocked out this card, and then it's chipping away at it. So both are great ideas, and it's right there on our site. You could take a look at it and see which one makes sense for you. So.
for sure. Yeah.
Yeah. So when it might actually be the right move for somebody, Craig? I mean, I recently did a loan for somebody, but let's give a scenario. Like, what's some of the ways it could be a right move for somebody?
So I think when the terms that you can get by using your home are dramatically better than any other option, and you've dealt with why the debt is there. So credit cards at 22, 24 or higher percent interest rate versus a mortgage rate, it's definitely a different universe. The monthly relief can be the thing that keeps somebody from drowning. But you've got to have some guardrails. I mean, if you rerun these balances up. So one way that we really like to look at this is if the goal is to really get out of the debt and you're used to be paying, $1,400 a month across these different debts, and now you're able to get these better terms, and now you're allowed to pay, $600 a month. Now that's $800, and what we're saying is, hey, if you pay what you're paying now with these better terms, now you're throwing an extra $800 a month at the debt, and you really can attack it very aggressively. And that's how you will get really relief of the debt without stretching a 4-year debt into a 20-year debt. So you might need to cut some cards up, so the temptation's not in the wallet if that's what you think might be helpful for you. But the discipline is the price of admission. If you bring that, it can be a really powerful thing. If you are not disciplined and now you evolve your house, it could be a pretty expensive mistake over time.
Yeah, I think we saw a lot of this in the mid 2000s, where the homes were going up significantly, the values were going higher, lending was looser. There were people who were, cash out refinancing and pulling stuff out to pay off, and it happened really, really fast, rapidly. That was 20 years ago. There's a lot of people now that they bought maybe 10 years ago, and they've got some significant equity in their home,
Yes.
and this could be a smart tool for them to use it. And like you said, they have to run the numbers and see if it makes sense, and see if the cost and the saving is long term, and they got to be disciplined.
That's right. And and it's interesting. I have a little quiz for you.
Oh,
So
okay.
yeah, and because we'll go into some examples
Sure.
that I wanted to show. But as I was doing the research for this, I started trying to figure out, okay, so Bill, what do you think the average credit card interest rate in America is right now?
22%.
Yep. So it's about 22 to 24% is what it's saying. Yeah. This was an interesting one. What do you think the average new car loan amount is today? So what do you think the average new car loan, not the rate or anything, but just like
Yeah,
the
yeah.
balance of
I'd say 35 grand.
you would be a little light. $44,000
Wow.
is the average car loan. And what do you think the average new car monthly payment is? Average.
Based on what I see, I'm going to say $700.
$770 a month. That's what it said. $770 a month.
I've bought a new car in quite some time, so
Yeah. So, and then here's a good one. What percent of new car loans stretch past 72 months? So past 6 years.
50%.
Not that high. More than a third, though. So
Okay.
people are financing cars 6-7 years just to make the payment work. So,
Wow.
yeah.
We see it all the time. Yeah.
Yeah. And then average unsecured personal loan balance, and it's a record high right now. What do you think?
40 grand.
Lower. 11,700. So a little under 12 grand.
I just threw some high number out there, just kind of, because you said it was the highest ever, so I was a little shocked. So
No, no, no.
700,000.
Now that might not, but that's a personal loan balance. This is like, that's not a credit card. That's like
Oh,
one of
okay.
these.
Those unsecured loans that we've seen with some of them lenders, and those are kind of some mini debt consolidation. If they don't own a house and they want to pay off $15,000 of credit card debt, I see that there's some of these lenders that do that online. I've seen those. Okay, so those
And what do you
personal
think? What do you think the average rates are on those?
12%.
12 to 15%. Yeah.
Yeah.
So, yeah. So that's so Americans are carrying record balances on some stuff. Some of the rates are pretty brutal. And the bleeder on a lot of this stuff is the credit card rates.
Oh yeah.
And that's kind of the debt that this whole conversation is really about. I mean, a lot of the other stuff's fairly manageable. So you want to run some numbers?
Let's run some real numbers.
Yes, I'm going to show you a couple of examples, Bill.
All right.
While I'm pulling this up, do you want to tell me about about that customer of yours?
Yeah, so past client of mine, I mean, they bought 8 years ago. They bought a house here locally, I think, for about $700,000. Today's value is about, I think, 1.1 in that area, and they had put 20% down. They bought it, and they decided that, hey, we want to access some of that equity, borrow some smart money. We got a 10-year fixed rate loan, and they got a 10-year fixed rate loan in the low. I think it was like 6.125%. And to them, it was smart money, and and there's still plenty of equity in their home. So they didn't want to touch the first mortgage because they had a mortgage, probably 3%. And they wanted to be able to access the equity without refinancing that first mortgage. And this is a great product for them.
I think people would be very surprised to hear that they could get a rate in the low sixes as a second mortgage on a property. So
Absolutely.
that's pretty neat. All right, I've got one of the first examples up. So, and this is kind of the what we were looking at. So this person, let's say they had $25,000 in credit cards. They're paying 23% interest rate on that. Their monthly payment's $500. They got an automobile payment. The rate on that's not terrible, 7%. They're paying $776 a month. They owe $40,000, and then they've got another personal loan for $15,000, $400 payment. They're paying 14% interest rate on that. So the new, basically consolidating all that into one new loan. In this particular example, because they're paying currently $1,676, they were going to be allowed to pay $972, so they were going to actually free up $700 a month in their monthly payments. If you're going to take the serious step of involving your equity on your house, instead of just lowering your payments and not doing anything about the debt, if you take the same cash flow that they were used to paying and throwing it all against the new debt, you were taking something that was going to be paid off, on track to be paid off, that all that debt was on track to be paid off in 13.9 years, and paying it off in basically 5 years and getting all that debt done with the same cash flow that they're doing right now. So that's, if that was interesting to somebody, that's be a situation where I could say, hey, you're being serious about this, you can involve your home equity, that could be pretty empowering for somebody. So
Absolutely. You're paying it off. And how much interest are they saving? I mean,
well, this is saying that they would save about $55,000 less in interest over that period of time. A lot of that is because that that credit card at that minimum payment, that's gonna be there forever at that kind of an interest rate. I mean, that's gonna take a really long time to pay that off. And this would be counter to the idea that some people go, well, I never want to take my 5 or 6 year car loan and involve the equity in the house, which I don't disagree with.
Yeah.
But the idea that, okay, that means I'm going to be paying on this car for 10 years or 20 years doesn't have to be the case if you've got a plan and you're going to stick to it. So
and you're saving so much money off the credit cards, and you're utilizing that, and you're freeing up that cash flow. You're taking that savings and apply it towards the principal of all that debt. That's a huge difference. That's kind of the textbook case, Craig. I mean, do we have any other options?
So I've got a different example here. So this example, somebody's got again some credit cards. $18,000 of credit cards. They're paying 23% interest. The same person's got the $40,000 car loan. They're paying $776 a month, 7%. They get another credit card. They're paying 21%, another 13 grand, and a Best Buy card. They're paying 19%, 6 grand. And then this, initially, so they're paying 1550 almost today. New payments closer to $1,000. So it's saving $530, dollars in cash flow now. And then if you look at what that accelerated payment plan could do, again, they were going to be on track to pay it off in 14 years, approximately, the way they were going, all the debt. And they could get the whole thing knocked out with the same cash flow they're doing today in 5.5 years. And that's including the fact that there's closing costs involved and things of that nature. But it's the fact that you're getting some better terms on all the debt and using the same discipline to take the same cash flow and knock it out and kill it and get rid of it. So,
yeah, you have to be disciplined. So even in that scenario, that would
yeah.
still work, and that would still make some sense. But is there one where, hey, let's pump the brakes here? Maybe you shouldn't do this. So do you have a scenario that shows us that?
I think I've got that one right here. So let's see. Okay, so this one, somebody's got $58,000 in student loans, right? They're paying $800 a month. It's at 7% interest rate. They get an Apple card, $1,600 balance, 21% interest rate. They get another automobile loan. They're paying $300 a month, 5%. And then they get a Discover card with 6 grand. And that's 24% interest rate. They're paying $150 a month. So initially, they're saving $361 a month. Okay. They were paying $1,300. Now they're going to be allowed to pay, $940 basically. And even though they're getting, in this particular example, the rate was in the, in the mid sixes, which seems pretty nice. Really, they weren't they weren't as much at a huge cost basis. The old way, they were going to pay off all their debt in about 8 years, and this was going to help them pay it off in 6.5 years. They would be paying it off a little, less than a year and a half earlier, saving $7,000 in interest even after closing costs. But, that's a bit probably, you could almost,
That's kind of a stretch.
You could almost do that one on your own, maybe just take a little bit of extra money instead of wrapping up the equity of your house, paying some closing costs, so I think that's one of the things that I always enjoy some of those conversations with customers where we tell them, no, you shouldn't do anything because
No, absolutely. That's what we're here for. We're helping to guide the client along if it doesn't make sense for them. I mean, that's I think this particular tool and what we're talking about, it's for the right person in the right situation. But there's plenty of times we talk to people about what they're trying to do or what they think they have in mind. They would like to have some benefit, and we go, listen, it's really not enough of it there to go through this whole process and incur the costs and everything. So that's the honest answer that we try to provide, and not everybody does that.
Listen. There's a lot of there's a lot of salespeople out there. They're like a hammer looking for a nail. So you ask them and about something, and they have a product they can sell you. That's what they do. That's what their job is, right? So
it's funny when you're speaking about high interest. I had a young lady, nice young lady, that did her mortgage probably about a little over a year ago. Professional, works in healthcare locally. And she was going to put like 5% down on the mortgage, and she had a credit card with like $24,000 balance. And it was one of these big bank credit cards where there was traveling and stuff. And she's like, I looked at the interest she was paying, at 24% monthly. It was ridiculous. And she was making a little more on the monthly payment, but not much more. And she had the cash in the bank. And she's like, yeah, but I get these Sky Miles. I go, yeah, but you paid like $20,000 in interest, over the time. And even on an annual basis, I said, listen, you really should take this money and pay it off. It's gonna pay this stuff. It's gonna limit. I know you get a free airplane ticket once in a while. And she, at the end of the day, she decided to pay it off. She thanked me for doing it. Instead of that money sitting in the bank, garnering maybe 1 or 2%, she was paying that ridiculous amount of interest. And sometimes people, they don't see it. They just look at that minimum payment and they don't realize how much credit, when you're paying a credit card for 22, 23%, how much you're paying per month,
It's tough to get rid of it when the rate is that high.
Yeah.
So so hopefully this is helpful for some people. I would say check out that tool on the website. If you're watching this because you saw it, because you had some debt and you're wondering about how to get out of it, play around with the tool on the website. I'm sure there's plenty of things out there on the internet that do something similar.
But ours is better. Ours is better, Craig. It's the Debt Payoff Planner. You got to check out ours.
That's right. The patented Debt Payoff Planner. So, but check that out. And then if you want to have a conversation about, hey, how much better would a consolidation be versus what you could do on your own? Be happy to help you. That's what we do. So
absolutely.
Yeah.
Reach out to us, give us a call. And then, so we'll wrap up our episode today with we always talk about kind of market conditions, right, Craig?
Correct. Yes. So we had an inflation report this week. So we just had the inflation report come out. It came out benign. It came out as expected. The market typically likes when things turn out as expected. They don't like surprises. And so they certainly don't like bad surprises. So anyway, this has been overall a mildly positive week for mortgage rates. Interest rates did not get worse this week. Interest rates probably did not get worse. They'd probably not gotten worse the last 2 weeks. But we're kind of meandering in this, 6.5% to 7% interest rate range, right, Bill?
Yeah. And according to the Freddie Mac survey, it's first time I think in 6 weeks it's kind of trended, but we've seen that trend slightly go downwards. We're still in the upper sixes, but rates are moving in the right direction today.
Yes.
Yeah. It could change tomorrow, but
Yep.
But that's where we are today. So, and nothing earth shattering, and going on in the market right now, but good stuff. And locally here in South Florida, if you are a first-time home buyer, we have down payment assistance programs available. The Hometown Heroes program is out there, and there's a lot of good deals out there right now. There's a lot of homes for sale. You can negotiate with these sellers. You can get some seller-paid concessions. The 2-1 buydown is a great program. So we got a lot of good stuff happening. So if you have any questions anytime, give us a shout. We'd like to, help you close more deals.
Absolutely. And I would just say, we're into week 2 of the new condo rules that are out there. And so we've definitely seen an uptick in kind of noisiness with some condo deals. And we've been getting a lot of calls from people who are in a condo transaction and there's some kind of an issue with with an existing lender on the condo. The Fannie Mae changed the rules at the beginning of the month. Now there's no more limited reviews available, which we've covered in a bunch of other topics. But anyway, we review condominiums for people every day. And so if you're an agent listening to this, if you have a listing on a condo, definitely communicate with us. We can help you understand what to collect from that seller, understand what financing options may be available in your building. If you're a buyer, it's definitely, we try to give you as much information as possible up front as we can on these deals before you go to contract and start spending money. So that's
it's huge. Yeah, people don't realize it's huge. And I tell the agents I work all the time, listen, if you're a buyer's agent and you're going to show a condo, check with us first. If it's on the approved condo list, it's going to make your life way easier, number one. Number two, they're not going to have to pay for that condominium questionnaire. Remember, when you go to contract, you're already paying for an inspection and possibly an appraisal. Now this condo questionnaire, they could be out $2,000. And if it's on the approved list, we do not need that condo questionnaire. So we have access to that. We'll check it for you right away. And we'd love to help you close more deals for sure. So
that's it. So anything else, Bill?
Nope, we're all set, Craig. So, I got my Aloha Friday shirt on. I got my new hat, and we're ready to rock and roll. So,
sounds good.
Yeah. All right, Craig. So let's wrap it up, and we'll see you
at the closing table.
Table. All right. Have a great day.
Okay, bye. Thank you for watching and listening to the South Florida Mortgage Report, brought to you by Capital Partners Mortgage Services.